So what are the factors affecting bond prices? Because the market forces cause interest rates to fluctuate and in turn will cause changes in the market price of a bond, interest rates are the major factor influencing its prices. Because of that, we say that bond owners have an interest rate risk. Inflation is a component of interest rate, and if inflation changes, so does the interest rates and the bond prices will change. The other factors are time to maturity and coupon rates. The general rule is that the longer the maturity, the greater the price risk is. Why is that? Because the present value of cash flows will greatly be affected if we have to discount 30 years as opposed to, say, 5 years. Remember, as a bondholder, you have to wait 30 years to get the principal back. Anything can happen in 30 years. Interest rates can change dramatically. Plus, there is an opportunity cost of investing those $100 somewhere else. At the same time, the lower the coupon rate, the greater the price risk is. The same logic follows. Because you get a small amount on your coupons, you can use less now to invest somewhere else. If we have two bonds with the same maturity but different coupons, the value of the one with low coupon will depend more on the principal amount to be received at the end. So if you have a lower coupon, you rely more on the money you get at the end, therefore it will be riskier. On the other hand, the bond with higher coupon will have large cash flows early in its life, so its value is less sensitive to the changes in the discount rate. So if we have two bonds with the same specification except time to maturity, we see that the price of the shorter maturity bond, the green line, is less sensitive to the changes in the interest rates, as opposed to the price of the 10-year bond, which shows a steeper curve. The steeper the curve means the more sensitive the price is to changes in the interest rates. We said the interest rate of a bond or yield plays an important role in bond valuation, and these interest rates are influenced by the level of inflation in the economy. And here we differentiate between the real rate, adjusted for inflation, and the stated rate or the nominal rate, which has not been adjusted for inflation. The difference between the two is that the stated rate shows the return or percentage change on an investment in terms of number of dollars you have. The real rate shows the percentage change in how much can you buy with your dollars. In other words, the percentage change in your buying power. The Fisher effect shows the relationship between real, stated, and inflation rates. The approximation works pretty well too, with normal real rates of interest and expected inflation. If the expected inflation rate is too high, then there can be a substantial difference between the calculation using the two methods. In the financial markets, the interest rates quoted, the discount rates, the yields, the rates of return, they are almost always quoted in stated or nominal terms, unadjusted for inflation. Let's have a look at this small example. If we require a 10% real return and we expect 8% inflation, what is the nominal rate? We can solve this either by using the Fisher effect formula or the approximation. As you can see from the example, there is a large difference between the approximation and the Fisher effect when the real and inflation rates are high. Following this equation, you can also find the real rate if you are given the stated rate of inflation. You rearrange the equation and then you solve for the real rate. This figure shows how volatile interest rates have been over time and how inflation is one underlying cause of the volatility in yields. The graph shows the yield to maturity of a 10-year Treasury bond, the top chart, and the inflation in the bottom chart. Because changes in interest rates cause bond prices to fluctuate, bond investors must be aware of this interest rate risk. Now let's look at the types of bonds that are available in the market. And we classify them in two groups, by issuer and by feature. So when we look at the issuer types, we have government bonds, which are used to fund budget deficits and build infrastructure, and are of three kinds based on the term to maturity. The treasury bills with less than 1 year to maturity, the notes with a maturity between 1 year and 10 years, and the bonds with a maturity greater than 10 years. Also, we have corporate bonds. Again, if maturity is greater than 10 years, are called bonds, and if the maturity is less than 10 years, we call them corporate notes. Bonds by features are fixed versus floating rates, where the coupon is tied to the cash rate or the government bond rate or the bill bank swap rate or other interest rates. So the floating rate bonds don't have a fixed coupon. They're allowed to vary. Then we have secured versus unsecured bonds. The secured or debenture bonds are secured or backed by specific assets. We call that collateral. While unsecured bonds are backed only by general faith and credit of issuer. Examples of such type of debt securities are mortgage bonds, collateral trust bonds, equipment trust certificates, and bonds secured by real estate, financial assets held in trust or transportation equipment. The zero coupon bonds, as the name implies, pay no interest, have zero coupon. These are also known as discount bonds or pure discount bonds because they sell below very low value, below par value. In Australia, we have dingo bonds, the Australian government discount bonds. So dingo stands for discounted investment in negotiable government obligation. In the US, there are the treasury strips. Then we have convertible bonds, which in addition to paying coupon offer the right to convert the bond into ordinary shares of the company that issued the bond. While exchangeable bonds are convertible in shares of a company other than the issuer's shares. And then we have callable bonds, which are bonds issued with the right to repurchase the bonds at a specified price, call price, in the future. In this instance, the companies could retire and reissue the debt if interest rates fall. Putable bonds, where the investors have the right to sell the bond to the issuer at a predetermined price in the future. As a protection from default risk, bond issuers have sinking fund provisions where the borrower is required to make regular payments to a trustee, which gradually repurchase outstanding bonds. Also, protective covenants specifying requirements the borrowers must meet. These covenants can be positive or negative, and we will talk more about these later in future modules. The bond ratings firms are Moody's, Standard & Poor's, and Fitch. Their ratings are based on how likely the firm is to default and what protection the creditors have in the event of default. The ratings are classified into two groups: investment quality or investment grade bonds and junk bonds. In the investment quality group, a bond rated AAA means that its capacity to pay is extremely strong. On the other hand, a bond rated BBB is a bond which means that the capacity to pay is adequate, while adverse conditions will have more impact on the firm's ability to pay. In the junk bond classification, we have bonds that are also called high-yield bonds. These bonds are riskier with respect to the capacity to pay. The B ratings, BB, have the higher degree of speculation. The rating C means that these bonds are income bonds with no interest being paid. Bond ratings, however, do not address the issue of interest rate risk. So an investment quality bond with a rating of AAA can still be volatile in price. This table shows the relationships between bond ratings and yield spreads between the US corporate bonds and US Treasury notes with different maturities expressed in basis points. Note that 1 basis point is equivalent with 0.01%. How do we read this table? For example, a 10-year AAA rated corporate bond offers a yield that is higher by 58 basis points from a 10-year Treasury bond. So we look at the first line until we get the column of 10-year bond. So the difference between a Treasury bond and the 10-year AAA rated corporate bond is 58 basis points. Or a 5-year CCC rated bond in the last column in the last row offers a yield that is 9.35% higher than a 5-year Treasury notes. The yield spreads reflect a direct relationship with default risk. The greater the risk of default, the higher the spread of the issuer's bond must be to compensate the investors for the risk they take. This table shows the countries currently with an AAA ratings on their government bonds. Australia is one of the 12 countries with these ratings, AAA ratings, on all agencies as Standard & Poor's, Moody's and Fitch. Note that the absence of the United States, which lost its AAA rating when there was the debt ceiling debate back a couple of years ago. And this is an example of bond quotation. This bond was issued by Heritage Bank. The coupon rate of 10%, paying interest every 3 months, and maturing in 2019. So that is in the second column, that information. Next we have the last sale, or the price of the bond and the last sale. Then in the next column we have the volume, specifying how many bonds were traded on this last sale. In this case, 900 bonds. And the total value of that trade was 92,868. Then we have the quotes, the buy and the sell spread, the differences between the ask and the bid prices. Bid means the dealer is buying at 108.60, and ask means the dealer or the market is selling at 108.80. So we see that they buy low and sell high, and that is how the dealer or the market makes money. The coupon rate is noted as 10% quarterly, paid until 27th of October 2014, with the next payment due on the 17th of November 2012. The bond has a feature of being able to be converted or bought back or switched to a floating rate note in October 2014. The principal or the face value or maturity value is $100. And in the last column we have the yield to maturity, which is 6.3%. Is this a premium or a coupon bond? There are two ways we can tell. Remember the relationship between coupon rates and yields. And here we can see that the coupon rate, stated at 10%, is higher than the yield to maturity. So we see that this is a premium bond. Also, we look at the quotes. We see that the quotes are higher than the maturity value of 100. The quotes, the buy and the sell of $108 gives us the indication that this is a premium bond. In the spread table, we observe that bond yields vary with maturity, showing a positive relationship, meaning as maturity increases, so does the yield for a given risk category. The relationship between yields and maturity is referred to as the term structure of interest rates. It shows the variation in yields across bonds with different maturities. This is depicted graphically by the yield curve, where the yield to maturity is plotted on the y-axis, on the vertical axis, and the time to maturity on the x, on the horizontal axis. In general, the yields on long-term debt are higher than those on short-term debt. Also, while yield curves are normally upward sloping, they can be flat or inverted during times of financial distress. This graph shows the yield curves for Australian government bonds at 1st of July 2010, the green line, and 30th of June 2011, the orange line. We observe that the 10-year bonds have higher yields than the 3-year bond.